You know, there's a price you never see on a store shelf, yet it influences almost everything you purchase. When you fill up your car, it's there. When you buy groceries, it's baked into the logistics costs. When you book a flight, it dictates the final price. Even a country's inflation rate often hinges on this invisible price. This is the price of a barrel of oil. And here's the fascinating part. Nobody truly knows what it should cost. Seriously. Ask any expert what the fair price of oil is, and you'll get a dozen different answers. $50, $80, $130. Over the last 20 years, this price has done unimaginable things. In 2008, it hit $147, and the world plunged into a crisis. In 2014, it collapsed by half in just 6 months, and entire nations were shaken. And in April 2020, something straight out of science fiction happened. The price went negative. Negative $37 a barrel. Imagine pulling up to a gas station and they tell you, fill up for free and we'll even pay you to take it. It sounds absurd, but that's exactly what was happening in the oil markets. How did a liquid from under the ground come to control the economies of entire countries? Why does its price ride a roller coaster, reacting not just to underground reserves, but even to politicians' tweets? And most importantly, how does this affect your life when you're buying bread or planning a vacation? Let's break down the price that moves the world. To understand how oil became the planet's most important commodity, we need to go back a century and a half. On August 27, 1859, Colonel Edwin Drake drilled the first commercial oil well in Titusville, Pennsylvania. And you know what for? Not for gasoline. Back then, nobody used it, except maybe veterinarians and pharmacists. Oil was needed for kerosene. People wanted to light their homes with something better than candles and expensive whale oil. First lamps, then engines. The invention of the first automobile changed everything, and gasoline replaced kerosene as the primary fuel of the industrial world. 2 world wars solidified oil's role as a strategic resource. But a new order was established after World War II. The entire oil market was controlled by 7 giant companies, which journalists nicknamed the Seven Sisters. These were Exxon, Mobil, Chevron, Texaco, and Gulf from the US, plus Britain's BP and the Anglo-Dutch Shell. As a result, for nearly 20 years, oil cost $2 to $3 a barrel. Cheap energy fueled economic growth. Suburbs in the US, cars in Europe, mass aviation. The Western way of life was built on the assumption that energy would always be plentiful. But by the 60s, things started to change. Producing countries realized they were getting too small a share of the profits from their own resources. And in 1960, 5 countries, Saudi Arabia, Iran, Iraq, Kuwait, and Venezuela, formed OPEC, the organization of the petroleum exporting countries, to control their resources themselves. Dependence on oil grew, and in 1973, the world felt it. The Yom Kippur War between Israel and Arab nations was followed by the OPEC oil embargo. Simply put, Arab countries declared no oil for those who support Israel. In just a few months, the price of a barrel quadrupled, from $3 to $12. What followed were lines at gas stations, fuel rationing, and universal shock. Everyone then understood oil is power. The 1973 crisis changed not only geopolitics, but the oil market itself. Prices became unstable, and the world sought ways to hedge against the volatility. This led to the creation of futures contracts, agreements to buy oil in the future at a fixed price. By the 90s, trading became electronic, and banks, funds, and speculators flooded the market. Oil transformed from a physical commodity into a financial instrument. Now the price was shaped not only by those who produced and bought oil, but also by those who were simply making money on it. And this brings us to the main question. If the price of oil isn't determined solely by underground reserves, then who actually decides what it should cost? If you think the price of oil is just supply and demand, like in an economics textbook, you're seriously mistaken. It's actually a complex game where the physical laws of the market intertwine with psychology, politics, and pure emotion. Let's take it step by step. Yes, supply and demand are indeed important. When the global economy is growing, China is building cities, India is developing its industry, Americans are driving more, the demand for oil increases. And when a recession hits, demand falls. Sounds logical. The supply side is also straightforward. If Saudi Arabia decides to increase production, prices go down. If there's an accident at a refinery or a hurricane in the Gulf of Mexico, prices skyrocket. But there's a catch. The oil market doesn't live in the present. It lives on expectations. Traders are buying and selling not so much real oil as they are betting on what will happen tomorrow, next month, or next year. Then there's seasonality. In the summer, Americans travel more for vacation, and gasoline consumption spikes. In July, the US consumes an average of about 11 billion gallons of gasoline. That's almost 2 billion more than in February. And now for who can actually move these prices. First on the list are the OPEC countries. The organization itself includes 12 exporting nations, but they've been joined by 11 allies, creating OPEC+. Together, these 23 countries control about 40% of the world's oil production. When their oil ministers meet in Vienna or Riyadh, the whole world hangs on their every word. If they decide to cut production by 2 million barrels a day, the price jumps. If they hint at increasing quotas, the market slumps. The second player is the United States, not just as the largest consumer, but also as one of the leading producers. The American shale revolution changed the game. Hydraulic fracturing technologies made it possible to quickly start and stop production. This made the market more sensitive to price. When oil rises above a certain level, say $70 to $80 a barrel, American companies start actively drilling new wells. The whole cycle usually takes just a few months. This sharply increases supply and limits further price growth. This mechanism is known as the shale ceiling. It's not fixed, but it acts as a restraining factor. If price hikes could previously last for years, now the market reacts much faster. This means speculative rallies have become shorter and volatility has increased. The third factor is China, the world's second largest economy and the largest oil importer. The country buys over 10 million barrels every day. China is the main engine of demand for commodities. When Beijing announces new stimulus measures like infrastructure investments, auto industry subsidies, or a key interest rate cut, the markets read this as a signal. The economy is reviving, factories are consuming more energy, and therefore oil will be in demand. Against this backdrop, traders start buying futures and the price rises. But during periods when China releases weak statistics on industry, construction, or consumption, the market reacts in the opposite direction. Even news about local lockdowns or a spike in unemployment can affect the price of a barrel. That's how powerful China's role is in global energy. But the most interesting players are the financial speculators, banks, hedge funds, trading houses. They trade oil without ever seeing a single rig. For them, it's just numbers on a screen. Reports, weather, tweets, everything becomes a signal to buy or sell. A report on overflowing storage facilities comes out, and they immediately cut their losses, dumping positions. A rumor of a hurricane in the Gulf of Mexico spreads, and the very same traders are already building positions, betting on a price increase. And finally, the most surprising thing, sometimes the deciding factor is simply market sentiment. For example, in 2018, Donald Trump tweeted, "Looks like OPEC is at it again. Oil prices are artificially very high, no good, and will not be accepted." As a result, the price of Brent crude fell by almost $2 that day. Just one tweet, and the market reacted instantly to the tune of billions of dollars. Or take 2020. On March 9th, OPEC Plus talks reached a dead end. The countries couldn't agree on production cuts during the pandemic. In response, Saudi Arabia sharply increased production and slashed prices. The market reacted with panic. The price of oil plunged by more than 20% in a single day. News outlets dubbed it Black Monday. So it turns out that the price of oil is shaped simultaneously by Saudi ministers in Riyadh, trading algorithms on Wall Street, and Chinese statisticians publishing GDP growth data. And sometimes it's just one person with an important title and a social media account. And now let's look at the most paradoxical moment in the history of oil, when its price went negative. Let's go back to 2020. On April 20th, something economists had considered impossible happened. The price of West Texas Intermediate, or WTI, crude oil fell to minus $37 a barrel. Sellers were paying buyers to take the oil off their hands. Sounds absurd? You bet. But behind this absurdity lies the simple and brutal logic of the market. The thing is, by April 2020, the world was facing a perfect storm. COVID had forced half the planet to stay home. Planes weren't flying, cars sat in garages, factories shut down. Demand for oil plummeted by 30 million barrels a day, a third of normal consumption. But oil production continued. Shutting down wells is expensive and technically difficult. The OPEC Plus talks had failed, and some producers decided, if we can't agree, let's fight for customers with low prices. To do that, you need more oil. So they ramped up production just as demand vanished. The result? The world was literally drowning in oil. And that's when the real problem began. The oil had to be stored somewhere. All the tankers were full. All storage facilities were at capacity. Even the underground caverns of the US Strategic Petroleum Reserve were overflowing. And the oil just kept coming. Imagine this. You hold a futures contract for 1,000 barrels of oil for May delivery. Normally, traders just sell these contracts before they expire. Buy, sell, pocket the difference. Nobody actually intends to handle the physical oil. But here's the problem. The contract expires tomorrow and there are no buyers. Everyone knows that if they don't get rid of the contract, they'll have to take delivery of the real oil. And where would they put it? All storage is full and renting a tanker costs more than the oil itself. What do? That's right. You're willing to pay anyone who agrees to take this oil off your hands, even if it means paying them $37 per barrel. So a negative price isn't a market breakdown. It's the market working too well. When supply drastically outstrips demand and there's nowhere to store the goods, the price can become anything. The most interesting part is that the next day the price went back into positive territory. Why? Because the problematic May contracts had expired and the June futures were trading at normal prices. This event showed one key thing. The price of oil isn't just about geology and geopolitics. It's also about logistics, contract deadlines, psychology, and sometimes pure panic. And it showed that even the world's most important commodity can become a toxic asset if there's nowhere to put it. Seeing such unpredictability in traditional markets, many are starting to look for alternative ways to preserve and grow their capital. One of these can be cryptocurrency. But here too, people often choose unreliable tools to manage their assets. A few years ago, our team chose Bybit, and it's been our anchor in the highly volatile crypto market ever since. You can grab bonuses via the link in the description or simply enter code 24676 when registering on the exchange. Don't miss your chance to step into one of the fastest growing markets. But let's get back to the oil market. Negative prices are an extreme case. In normal life, oil affects economies in a much more predictable way, and that impact is colossal. Imagine the price of oil rises from $50 to $80 a barrel. Just a $30 difference. Doesn't seem like much, right? But those $30 can turn the economies of entire countries upside down. Let's start with those who sell oil. For Saudi Arabia, Russia, and Norway, a price increase is like winning the lottery every single day. Their national budgets are directly tied to oil revenues. When oil is expensive, they have money for infrastructure, social programs, and other expenses. When it's cheap, they have to tighten their belts. Russia, for example, pegs its budget to a price of $60 to $70 a barrel. Anything above that is a bonus that can be spent or saved in funds. Anything below means a deficit and spending cuts. But there's a flip side. Expensive oil for exporters means expensive fuel for everyone else, and fuel is the foundation of the modern economy. You can feel this literally at the checkout counter, because the truck that delivers bread or apples to the supermarket doesn't run on air. If oil gets more expensive, transportation costs go up. And right behind them, the price on the shelf. So when a barrel of oil goes up in price, we don't see it on a chart, but on our grocery receipt. And then there's aviation. Fuel makes up a third of an airline's expenses. If oil prices rise, so do ticket prices. Simple arithmetic. But the most interesting thing happens with currencies. When oil prices rise, the currencies of exporting countries strengthen. The ruble, the Norwegian krone, the Canadian dollar, they all go up. But the currencies of importing countries, on the other hand, weaken under the weight of their oil bill. Central banks around the world watch oil prices closely. Why? Because a sharp price spike can trigger an inflationary spiral. Expensive oil means expensive gasoline, and expensive food leads to demands for higher wages, which in turn leads to more inflation. Remember 2008? Oil hit $147 a barrel. In many countries, inflation jumped to double-digit figures. People spent more and more on gas and food, leaving them with less for everything else. The economy started to slow down, and then the financial crisis hit, oil crashed to $30, and instead of inflation, the world got deflation and recession. This creates a paradox. Very expensive oil is bad for the economy because everything becomes more expensive. But very cheap oil is also bad, because it usually means the global economy itself is in crisis and nobody needs oil. Is there a golden mean? Most economists believe the optimal price is somewhere in the $60 to $80 range. High enough to encourage investment in new oil fields, but not so high as to stifle economic growth. But the market is rarely so reasonable. It swings between extremes, and countries are forced to adapt to this roller coaster. However, there are countries that have managed to turn the oil roller coaster to their advantage and become one of the world's major economic centers. Picture this, the mid-20th century. Fewer than 500,000 people live in the 7 Emirates. The economy is based on fishing, pearl diving, and coastal trade. Dubai is a fishing village. Abu Dhabi is a fort in the desert. Starting in the 50s, a British company, the Abu Dhabi Petroleum Company, a BP subsidiary, drilled well after well. The first attempts were all failures. But in 1960, the Murban 3 well finally produced a commercial flow of oil. Almost simultaneously, the French and British discovered the offshore Shaif field, and the game was on. In 1965, the local ruler, Sheikh Shakbut, signed a classic 50-50 agreement with the oil companies, where half the profit stayed in the country. But Shakbut was a cautious conservative. He saved money, he didn't spend it. In August 1966, he was replaced by his brother, Sheikh Zayed, and from that moment on, everything changed. Sheikh Zayed understood a simple thing. Oil isn't a business, it's seed capital. And as early as 1967, he established an investment fund, the future Abu Dhabi Investment Authority. Today, the fund manages nearly $1 trillion. From 1962, oil began to be exported from the terminal on Das Island, and every petrodollar was put to work. Roads through the desert, schools, hospitals, airports. And in 1971, after the creation of the United Arab Emirates, the fastest economic transformation in human history began. In 50 years, the country's population grew more than 20-fold, from 500,000 to 11 million people. And from there, it was all about scaling up. In 2017, a new sovereign wealth fund was created, the Mubadala Investment Company. By 2012, it was managing assets worth billions of dollars. Mubadala invests in 50 countries around the world, from tech startups to real estate. As a result, in the first 9 months of 2024, the UAE's economy showed a GDP volume equal to the entirety of 2020. And this is despite the fact that today, 75% of the economy is no longer dependent on oil. For comparison, in 2009, over 85% of the UAE's economy was built on oil exports. This means that in just 15 years, the country has completely flipped its economic model. And here's the paradox. When oil is expensive, the country gets richer. When it's cheap, it barely suffers because 3/4 of the economy has long been independent of oil. The Emirates turned a temporary resource into permanent assets. But the story of the UAE is more the exception than the rule. Some oil-rich nations have gone down a very different path. And strangely enough, for them, vast reserves of black gold became not a blessing, but a curse. There's a cruel irony in economics. Often countries with enormous oil reserves are worse off than those with none at all. Look at Venezuela. the largest oil reserves in the world, yet an economic catastrophe. Now look at Switzerland. No oil at all, just banks, watches, and stable institutions. And everything works. What's happening? Economists call this the resource curse, or Dutch disease, and there's a real story behind that name. Let's go back to 1959. The Netherlands discovers the Groningen gas field, one of the largest in the world. Over its 60-plus years of operation, this field brought the Dutch budget 400 billion euros in today's prices. It sounds like a jackpot. The country could live happily ever after. But instead of an economic miracle, the Netherlands got a headache. Gas revenues strengthened the national currency, the guilder. A stronger currency made other Dutch goods and services less competitive on the global market, leading to a decline in exports in other sectors. Imagine this, the whole world used to buy Dutch ships. They were high quality and affordable, but when the guilder strengthened due to gas revenues, those same ships became too expensive for foreigners. Many traditional Dutch industries like shipbuilding and textiles faced difficulties, and unemployment in the country rose. The logic is simple and merciless. When a country has one highly profitable resource, everything else becomes unprofitable. Why develop shipbuilding when you can just pump gas? Why invest in high tech when your main income comes from something nature gave you for free? As a result, the economy turns into a one-armed bandit. Gas is expensive. Everyone's rich, gas is cheap, everyone's poor, and there's no plan B. Venezuela is a perfect example. In the early 2000s, when oil was over $100 a barrel, the country was swimming in money. There were social programs, subsidies, and massive investments. Then prices collapsed, and so did the entire economy. Inflation reached an unprecedented 1,000,000% per year. People fled the country by the hundreds of thousands. Here's another example. Nigeria, Africa's largest oil producer and one of the countries with the largest reserves in the world. And yet, according to the World Bank, over 40% of its population lives below the poverty line. The oil sector provides up to 90% of export earnings and more than half of the federal budget, but it only makes up about 10% of GDP. When oil prices fall, other sectors can't compensate for the losses and the country faces a deficit. There's another nuance. When a country lives on oil revenues, the government has no incentive to develop institutions. Why have an efficient tax system if the main income comes from selling resources? Why be accountable to the people if the money comes from the ground, not from citizens? This creates a vicious cycle. Weak institutions can't effectively manage oil revenues, and oil revenues provide no incentive to strengthen those very institutions. But the saddest part is the dependency on price. When oil gets cheaper, these countries can't just tighten their belts. They don't have a diversified economy that could offset the losses. They find themselves hostage to the global oil market. But even those who are building their future on new technologies still depend on oil for logistics, chemicals, and energy. So what will happen to this market in 10, 20, 30 years? If you listen to environmentalists, in 20 years, oil will be a museum piece. Electric cars will replace gasoline ones, solar panels will replace oil-fired power plants, and carbon taxes will make fossil fuels economically unviable. Sounds logical. Tesla sold nearly 2 million cars in 2023. Impressive growth, but not as dramatic as it seems. The European Union plans to ban the sale of combustion engine cars by 2035. China promises to be carbon neutral by 2060. But there's a catch. Cars account for only a quarter of global oil consumption. What about the other 3/4? Take aviation, for example. Existing electric planes can fly 600 to 1,000 kilometers with a small number of passengers. Enough for regional flights, but not much more. Transatlantic flights with hundreds of passengers will be flying on kerosene for a long time to come. The energy density of jet fuel is dozens of times higher than that of the best batteries. This means that to get the same power, a battery would have to weigh many times more than a tank of kerosene. And for an airplane, weight is everything. The heavier the plane, the more fuel it needs, and the harder it is to even get it off the ground. Or maritime transport. The huge container ships that carry goods between continents run on bunker fuel, a product of oil refining. Try putting a battery in a ship that carries 10,000 tons of cargo. For now, it's unthinkable. And then the future, end of an era or a new chapter. There's the chemical industry. Plastics, fertilizers, medicines, synthetic fabrics, all are made from oil. Every day, you use dozens of things that simply wouldn't exist without oil. Your smartphone, your toothbrush, your sneakers, they all contain petrochemicals. Plus, there are developing countries where billions of people are just beginning to live a Western lifestyle. They need the same goods and transportation. As long as green alternatives are expensive, oil remains the foundation. The International Energy Agency predicts that even in the most optimistic energy transition scenario, the world will still be consuming 75 to 80 million barrels of oil per day by 2030. That's less than today's 100 million, but it's still a huge number. So oil isn't going away, but the market will definitely change. First, it will become more volatile. The lower the demand, the stronger the reaction to any shock. If today, the shutdown of one oil field affects the price by 2 or 3%, in the future, it could affect it by 10 or 15%. Second, countries with low-cost production will strengthen their positions, while high-cost projects will lose their competitiveness. Third, oil companies are trying to transform into energy companies. Shell, for example, is investing billions in wind turbines and solar panels, promising to direct up to $4 billion a year into green energy. But reality is more complex. BP, which in 2020 planned to cut its oil production by 40% by 2030, completely abandoned those plans in 2024 and returned to expanding its hydrocarbon business. But most importantly, the price of oil will remain a reflection of global processes. Only it will show not the growth of economies, but their transformation. So there you have it, guys. We started with a single number, the price of a barrel, and we ended up with questions that concern the future of the entire planet. Oil is no longer just a liquid from under the ground. It's a mirror reflecting technology, politics, and how we ourselves are changing. Write in the comments, what do you think the oil market will look like in 10 to 20 years? Do you believe in a rapid transformation, or do you think we can't do without oil? And don't forget to support us with a like. It helps us make our content deeper and more interesting. All the useful links are in the description below. See you. Bye.